Welcome to Leaders of Tomorrow Season 10. It's been 10 seasons of empowering India's small businesses such as yourselves. I'm Sunanda Jayasheelan. On the show tonight, as part of our Diwali Special edition, we're talking about commodities. Should you be investing in commodities? Should you have some percentage that's dedicated especially to that ever precious metal gold? And if so, what percentage of it, and what's the outlook on pricing? All of that being posed to our experts tonight. Let me introduce them. Feroze Azeez, Deputy CEO, Anand, Rathi. Prathamesh Mallya, AVP Research, Commodities and Currencies, AngelOne. Feroze, Prathamesh, so good having you here on the Leaders of Tomorrow, talking about something that's so crucial to our everyday lives, but also to our entrepreneurs, especially for those of our small businesses which look at commodities as an investment vehicle and mechanism. And we're talking all things commodities, we're talking prices, we're talking trends. But I want to start with what was part of my introduction, that commodities very often are seen as an important investment to have in your portfolio. Whether you're an individual who's looking at it, whether you are an entrepreneur who says some percentage of my exposure should perhaps be, or as an entrepreneur, whether your personal finance strategy for yourself and your family is that I should own, for instance, X percentage of gold. So I want to start there and ask the big question. We as Indians love our gold clearly, but should you be looking at it as an investment strategy? And maybe I can come to you first, Feroze. What would you have to say?
Yes, Sunanda, to my mind, of course, commodities could be a great investment because it has the diversity, right? Commodities could be precious metal, base metals, agri, and energy. These are the four categories of commodities. So from an investor standpoint, does it merit some allocation? The answer is a big yes. Okay. Reason being that it brings in huge diversity, right? Buying one stock and comparing it with another stock will be quite correlated. Now, there is kind of an inverse correlation of commodities with other assets which you have in your portfolio. That's point one. Point two, unfortunately, investing in commodities has been restricted to precious metal.
Yeah, and that too to gold, right?
Largely to gold. Yeah. Fortunately, over the last year or two, there has been evolution from gold to silver. There is a rub-off of gold becoming an investment vehicle to silver becoming an investment vehicle. But are base metals today an investment vehicle being available for investors? The answer is no. Okay. Will the industry evolve there? The answer is yes. Today, I think with the kind of exchanges we have on the commodity side, an arbitrager and a hedger definitely have instruments, but an investor does not have adequate instruments to partner his money or part with his money to different commodities.
So how should you do that, and why should you be doing that? I will come back to you, but I just want to give you also the chance for opening comments. Feroze is saying definitely yes, have some percentage of your portfolio as commodities. What would you have to say?
I think there are many asset classes wherein people invest in, but then commodities is something which is got least interest from investors. Probably we do not have any instruments from an investing perspective per se, but then people really do have investments in gold and silver primarily as a diversification tool. So in that sense, yes, commodity has the potential in comparison to other asset class from an investing perspective per se. And all the set of people who are involved in this asset class, right from the entire chain up and the cycle, I think it really gives investors an opportunity to take most of this asset class.
Okay, so let me then sort of ask you if you can give a thumb rule to someone who's watching today's interview to say, if you're someone who's, let's say, 25 to about 45, in that age bracket, you're an entrepreneur, what percentage of your exposure should perhaps be, as far as equities are concerned, how much should you be putting into commodity? This question is to you as well. But if you want to sort of set the ball rolling, generally, is there a thumb rule that you would suggest?
It really depends on the risk perspective of an individual. But if you're really asking from an entrepreneur perspective per se, I think he can have his exposure to gold and silver. He can probably balance his portfolio of investments. But then if you're really looking for a set of rules, okay, I will just have 50% of my investments in just one asset class, that will really not survive with the returns that you're looking at. So thumb rule, no thumb rule, it clearly depends on the risk perspective of the investor.
Okay. Can I sort of put you on the spot and say, give us a figure. If you are a young entrepreneur and you want to have some sort of exposure to commodities, what's a healthy exposure to have?
See, the healthy exposure in commodities, which is today synonymous to gold, unfortunately, assuming that this is what the industry is and it does not evolve, I would say 10 to 12% to even 15% in gold is a good thumb rule. Okay. Why would I say that? Is because it brings dollar into the picture, point one. Second is the gold has a certain degree of negative correlation with equity. So when equities fall, especially in exaggerated events like the global financial crisis, gold actually supported the portfolio. In 2020, when we saw COVID, again gold supported the portfolio. So it has certain degree of negative correlation with equity. Point one. Point two, especially those people who have global objectives. Now, if I'm an entrepreneur, I want to see my children studying abroad, then gold coming into the picture becomes more relevant. If I have an objective of spending abroad by traveling the world, then having a certain amount of gold is very relevant.
Okay.
Especially in low interest rate periods, because gold could be a replacement to debt. But unfortunately, we're going into a cycle which is a debt interest rate hike cycle. So if Government of India can give me 7.5, then the relevance of gold comes down. Gold over a 3-year rolling basis for this century has given 9.3% return, which is a healthy return, especially in a lower interest rate cycle. So let me give you a thumb rule of 10 to 15%.
10 to 15%.
But you have to look at the contemporary situation before you narrow down to that number.
So when we're talking gold, are we talking about jewelry? Are we talking about gold ETFs? What are we talking about?
So if you ask me, there are several vehicles you can get into gold, but when you're doing investments, don't distract yourself by any other thing other than the sovereign gold bond. The sovereign gold bond is a miraculous instrument. Why? Because it gives you 2.5% fillip on gold prices. A gift 2.5% every year is like the rental yield of residential properties in India. That's extra from Government of India. That's one advantage. The second advantage Government of India to motivate people to have digital gold is that they give you tax-free status at the end if you hold it till maturity. There are only two things which are tax-free from a capital gain standpoint. One is sovereign gold bonds and ULIPs or insurance policies below a certain level. Sure. So I think sovereign gold bond is what you have to look for. You should not look for anything else. A 3-4% added advantage on gold prices is something which you can't ignore.
So for everyone who is going out buying a lot of jewelry on Dhanteras and saying in some sense you're passing it on to your children, your grandchildren, and that's a investment in that sense, and that's seen as a security in that sense, what would you have to say to them?
So I would second his opinion of, say, if you're investing in gold from a long-term perspective of say 8 to 10 years, sovereign gold bond is a better instrument. Okay. But then as Indians, we are more attuned to buy physical gold and would not look at it from a returns perspective, because we do not want to part our gold and sell it just from a returns perspective. If you're really looking at investing in gold from a returns perspective, no other instrument other than sovereign gold bonds.
Both of you are saying that yes, it's essential to have an exposure to commodities in your portfolio, but it's not easy to do that. We've been talking about gold ETFs. So for the sake of our viewers, could you help them understand, are there any other form of ETFs available? How do you invest if you're interested in commodities? Should you be going only through the MCDX? How does that really happen? Maybe I'll come to you first on that, Feroze.
See, I think firstly, like you said, going back to the previous topic, when I say buying gold in the sovereign gold bond format, I don't say don't touch jewelry, because jewelry has some aspiration, it has some utility. Bars, coins, they don't have utility. You're not going to carry it in your pocket or wear it on your arm, right? So when you're doing jewelry, especially a country with 50% women, I'm not going to be saying don't touch jewelry for sure, right? Investment standpoint is replacing bars and gold coins. Coming back to your question of what are the instruments a person can use, like an ETF, an exchange traded fund for gold and silver exists. Now, for example, Nippon as an asset management company was one of the first few to add a silver ETF. Okay. That's point one. Gold ETFs is a very, very popular instrument in which you go to a broker, put your money in the ledger, buy the gold in the form of ETF, and then it gets credited to a demat account, just like a share does. There's no recurring cost. All your cost was the brokerage cost, largely. So you can just buy it and forget about it. That's one. there's also something called the gold fund, where the fund manager buys several ETFs for you. The disadvantage or advantage of both of them, in a gold fund, you can do a systematic investment plan of 1,000 rupees. But in a gold ETF, you have to pick up the phone and give an order, or at least punch an order yourself on your phone or your computer. So if you have 1,000 rupees, can you buy a gram of gold? The answer is no. But can you buy units of a gold fund? The answer is yes.
So for a retail investor, that is much easier. Yeah. So let me come to you. I was asking Feroze about the exchange, the Commodities Exchange. Has it really simplified the way people can approach investments in commodities?
I think we are talking about commodities and its education and comparing it to other asset classes.
Yeah.
So from that perspective, exchange along with the regulator are coming out with different options wherein there is a possibility that investing community can get into commodities. For instance, there are indices on option which is getting its breakthrough, and slowly and steady liquidity is coming in, which can similarly be compared to other index products which are there in equities. Yeah. So in that sense, yes, this market is evolving in nature. We are getting into a mode wherein we are not probably follower of international markets for pricing. We are probably getting into a mode wherein we are price setter of commodities.
We've only been talking about the metals. What about other commodities? I mean, are they also gaining any amount of popularity? I'll come to oil, that's separate, but any of the other commodities we could perhaps
yes, I think natural gas is one commodity which has clearly gained significant, and in terms of return perspective, it has almost doubled if you compare into pre-COVID and post-COVID. So price of X 100 is now almost doubled to 200. So that is the kind of return that natural gas has given. And the real difference here is what natural gas price we are comparing here is purely a mirror reflection of what happens in US. So it is a commodity which has a significant proportion of usage for industrial as well as derivative instrument. So what we have here as a pricing is clearly a mirror reflection of US NYMEX natural gas prices, and from a return perspective, this commodity has really performed well. So apart from other commodities, natural gas is one commodity which is gaining a lot of significance.
Gentlemen, I'm going to take a quick break on that note. We'll be back in just a moment. Do stay tuned. Welcome back. You're with us here on Leaders of Tomorrow. Tonight, we're talking all things commodities as part of our Diwali Special series. I want to talk oil, of course. During this special Leaders of Tomorrow Diwali edition that we've been doing, we've been speaking with companies across different industries in this limited edition special that we're doing. And everyone is saying to us, there's been huge demand which has been pent up for the past 2 years. And this festive period, people have started spending like never before, because they're going out, you're meeting your friends and families, you haven't done that for 2 years. So there is so much demand that's going in. So we're also seeing prices in some sense correspond with that. And my question is, as you're seeing this huge spike in manufacturing and in demand, I really want to discuss what's likely going to happen to oil prices. There's been some easing, of course, with the Ukraine crisis, etc. But in the midterm and in the short term, what can we expect as far as oil prices are concerned? You first, Prathamesh.
I think oil is a global commodity and it has really troubled every country across the globe. And rising oil prices is clearly an inflation threat, and because of which all the central banks across the globe are trying to control their inflation from their respective whatever tools that they have in their arsenal. But then from an oil price perspective, I think from high of almost $140 to almost around $80-85, there's a significant price correction that has been happened, and it really gives a boost to all the importing countries wherein they are oil dependent purely from import perspective. So it eases things out. So oil prices should remain higher or lower, but it should not be volatile.
In our opinion, oil is, of course, of major interest to India from different context standpoint, because for every $1 reduction in oil prices, we as a country save $2.5 billion. That's a lot of money we save. So that's some very, very interesting commodity for all of us as Indians. But coming to where the price has settled after the Ukraine war, it had spiked and then it settled. In our opinion, the next few months, at least the first half of the next calendar year, is going to be a little lackluster. Okay. But the second half, I think, will be a little
from a
pricing standpoint. I think hovering at these levels of 85 to 95 is what you can see. I think going back to triple digits is possible in the second half of the next calendar year.
Okay, I realized that I didn't get a pricing outlook for gold. We spent so much time talking about gold. If you're looking at the mid to short term, any sort of pricing outlook you can give us?
I think gold performance really happens in longer term perspective, and US, Europe technically in a recession. So if you look at historical standpoint, the performance of gold increases after 1 year. So if you're really looking from a price point from MCX perspective, 56,000 rupees per 10 grams, and on the international platform, it is close to $1,800. So $2,000 is what we're looking at from a year perspective.
Okay, do you want to add to that?
Yes, I think from a gold pricing standpoint, we have a very different opinion, not just from where it will go. Because India has 3% share in global GDP, but for all the gold ever mined, there is estimate that India owns 12%. Of gold, whereas the GDP ratio of India in the world GDP is just 3%. So we have been so bullish on gold, and gold is a global commodity, and gold is the only commodity which I know of, or any asset, which gave negative return for 23 years. In dollar terms, not in rupee terms. In India, you get a rupee value, and the depreciation definitely helps. So coming back, I personally think last 1 year has been not so good. 5% reduction in dollar prices, gold dollar per ounce, you see a 5% reduction. So I think that will get re-established, and $1,800, $1,850, $1,900 is surely possible. It might not be very tempting for an investor to buy at this stage, but because past performance doesn't show so lucrative, but I think you have to try and buy at troughs if you have to make money.
Prathamesh, we've seen how the benchmark indices have been really performing in the country, even on a global basis. You know, you're seeing BSE Sensex also doing so well. In terms of sheer volumes, talk to us about how the commodity markets in India have been performing, and do you have an outlook in terms of how much growth we can perhaps see?
I think existence of commodities and existence of equities go hand in hand, because equities cannot be listed without the business of having commodities. So in that sense, yes, the growth of commodity markets in terms of volumes has been significantly higher, and MCX majorly controls almost 90% of the commodities that have been traded in India. So in that way, yes, and the major chunk of this volumes has purely in two segments. One is crude oil and natural gas, and second is gold and silver. So these four commodities constitute major volumes as far as this exchange goes.
As an entrepreneur, we've been speaking, Feroze, about how you should, from a personal finance standpoint, you should perhaps be looking at commodities and what commodities you should look at. But for an entrepreneur who says, should I look at commodities as a de-risking strategy, what advice would you have?
See, if you're trying to de-risk the volatility of your own business, if you're in the business of very volatile P&Ls, then definitely a safe, lower volatility instrument can be used in your own proprietary book or your own company funds as well. Sovereign gold bonds can also be bought by entities like companies. So to answer your pointed question, can a business use some commodity? The answer is yes, and that should largely be gold, because the rest of the commodities might throw up volatility in numerical terms greater than equity itself. So if you're going to try and bring safety, then you measure the volatility. It needs to be lower than your other instruments. That's when you can actually bring in safety. Like an FD does not have any volatility. If the bank tells you 6%, if the bank is not bankrupt, it will give you 6.00. But commodity is not like that, right? Equity is not like that. So if it can throw up lesser risk than equity, then it has a space in a company's portfolio from a de-risking standpoint.
But Overall, would it be fair to say that commodities, and this is the view, that commodities are generally seen as more risky than being in the equity markets? Would you say overall that's the correct perspective to have?
See, I don't think it's a correct perspective to have, because you're comparing two asset classes in the different journey of evolution.
Okay.
Right? The volatility is high not because of the commodity, because of the lower volumes. If the volumes are lower, volatilities are always higher, because the buyers and sellers, like in real estate, if I want to buy the house today and sell it tomorrow, I'm not going to get the same price tomorrow, right? That's because liquidity is low. You'll have to find a buyer. So I think as liquidity comes, like Prathamesh Sir was saying, I think volatilities will reduce.
Prathamesh, Feroze, thank you so much for your time here on the Leaders of Tomorrow. Thank you. Thank you. If you have any feedback for us, do let us know. Our contact details are on your screens as we speak. Thanks for watching. Have a good night.